Hello everyone, this is Professor Wei here. In this video, I want to give you an introduction to the fundamentals of investing, which is a very interesting topic. So to motivate the subject, I want to talk about what we mean by investment and the role of economic factors in navigating your investment outcomes. What are the primary investment types, financial markets, and what are the different uh, financial asset classes, and how to define the return of assets. Okay, also I will share some of my views on the financial market during the COVID-19 pandemic. Okay, so over the next few weeks, we are going to talk about some primary financial instruments such as stocks, bonds, mutual funds, real estate, and so on and so forth. Okay, so let's get started. Well, the very first natural question is going to be, what is the investment? Well, what I want to do is to draw the distinction between two things, investment and speculation. Okay, so to visualize this idea, I want to show you guys one of my, actually my personal example, and that is, so it happens 3 years ago. This is the day before Amazon's earnings announcement in 2018. So usually, for all the listed company, we have the a quarterly earning announcement. Basically, it's a quarterly events that disclose firms, earnings and future prospects to the outside shareholders. Usually around these dates, price of stocks are pretty volatile. Okay, so somehow you know, uh, I had a strong confidence on the Amazon's earnings performance for that particular quarter. So I was very optimistic for the Amazon stock price for that earnings day. Okay, so I had the leverage, use the options, whatever other methods, strategies. That's not the key point. My point is I was very optimistic on the Amazon quarterly earnings report for that particular day. Okay, so the next day, it turned out to be my conjecture was completely right. Okay, soon after the earnings announcement released, right after 2 minutes after the stock market closed, and the stock price of Amazon jumped by 3.2%. You want to know that for a large cap company like Amazon, 3% is a very significant price jump for that particular day. Okay, so I was very happy at that moment. Well, do you think it's a very successful investment if you buy in a day before and then after the market close, totally they are around 6% in one day, right? I can tell you most of the time the annual return of whatever investment should be around 8%. So one single day, 6%, plus you have leverage options on some other strategies. The return was actually pretty decent for me if that's the case. Okay. Well, the reality is 20 minutes later, you can see the stock price dropped by almost a 4% within 20 minutes. Okay, so during that day, actually, there wasn't any surprising reasons. Okay, the facts of the life are is that nowadays most of the transactions are initiated by machine, okay, robots or automated trading. So as retail investors, we can hardly compete with our counterparty. Okay, so you can see actually 6 minutes later, another 1.5%, 2 hours later, the entire gain for that day was evaporated. It turns out to be totally around 7% decrease. Okay, it dropped by a lot. Okay, so there wasn't any surprising news on that day and nothing negative. All the earnings specific news are all pretty good. It's actually a very promising, very good financial report. But somehow the return wasn't very good, given the the performance during that day. Okay, so my point is, this is a speculation. Okay, so it's a pretty short-term event. Okay, it's a pretty short-term bet with a very high risk. The likelihood for you to fail the speculation is very high. Okay, for investment, you should look at the long run. Okay, of course, there are some short-term investment or medium-term investment, but you have to employ whatever fundamental analysis or technical analysis to endorse your decision. We want to make an informed investment decision in the whole process, as opposed to short-term bets. Okay, actually, I wasn't I actually I did lots of research, but still, because of the mixed market sentiment, because of the automated trading, because of many other unobserved factors, I really cannot time the market, not to even mention bet the earnings performance. Okay, so it's really hard for individual investors like us to, speculate the market, to time the market, to make, uh, bets on whatever firm specific event. That's kind of a a hard job for us to to do. Now, one important thing I want to comment on is, before whatever investment we want to make, okay, we always want to make sure we understand ourselves by asking the following questions. Okay, so we want to understand how much money do we need to satisfy our investment goals, or the initial outlay you need to put into the venture. Okay, and how long is going to be the investment horizon. Okay, because it matters a lot in terms of your return, in terms of your tax, because for the short term tax, it actually differ a lot from the long term, from the tax on the long term capital gain. Okay, so the investment horizon really is a really important thing. Uh, how much risk can you actually bear? So in other words, what's going to be your risk tolerance? Okay, so I have to say that it's going to be probably one of the most important thing on the list. We need to properly assess our risk tolerance. I can tell you, most of individual investors, we cannot properly assess our level of risk we can bear, okay, because of the a variety of behavioral biases we are subject to. Okay, so to do that, we have to get some practice to see how much loss or how much risk we can take. For young investors or for beginners, usually people tend to be overly optimistic, so that we actually take uh, you know additional risk that we can bear. Okay, so that's not a healthy practice. We want to properly assess our risk-taking level. Uh, in a separate video I will post later, I will share with you guys some of my thoughts on the behavioral biases in terms of the decision-making process in the investment. Okay. Anyhow, my point is, we want to understand our risk tolerance. Also, what are the possible economic or personal conditions that can potentially alter our investment goals? And are we willing to make sacrifices necessary to reach our investment goals? So in other words, we want to trade off the opportunity cost across different alternatives. And what are the consequences if we cannot reach our investment goals? So we want to fully realize the cost. So given the our personal economic circumstances, our investment goals reasonable? So we have to revisit our investment plan. Okay, so I do like this set of questions that can help us properly understand ourselves, because different individuals have different ability to process information throughout the investment process. Okay, so next I want to highlight the importance of economic factors in navigating our investment decisions. Okay, so for example, in finance, we emphasize the fact that a nation's business cycle can actually affect our investment by a lot. Okay, so let me show you one example. One of my favorite stock right now is Caterpillar, which is a leading giant in the manufacturing sector. Recently, because of the potential post-recovery pandemic, post-pandemic recovery, this stock increases. The price increased drastically. Okay, over the past 8 months. Uh, Here you can see from the bottom uh, of the price during March 2020, it almost increases by 100%. Okay, for a manufacturing stock like this is a pretty decent return. Okay, so, but that's not important point I want to make. What I want to say is that I want to convince you the fact that for a cyclical stock like this, it's actually, sometimes your return could be like this. Okay, you can see the stock price of CAT, the Caterpillar, during 2011 is at the level of 110. Okay, uh, it's still the same 10 years later. So if you enter the market at around time, it takes a very long time to get your money back. Okay, so let's just try to appreciate the curve like this. So if you look at this thing carefully, it's actually a very psychologically frustrated experience. Okay, so you can see you enter the market 2011 and dropped by 25%, upped by another 25%, dropped by 10%, dropped by another 50% 5 years later. Well, as retail investors, it's extremely hard for us to control ourselves given the long. I mean, even we want to hold a long-term horizon, probably we cannot afford to because of the potential liquidity constraints. Okay, so my point is, the business cycle does matter in overall financial investment decisions. Okay, so the other thing I want to point out is that the overall market news, the news that are coming into the market really matters a lot. Okay, it could be firm-specific news, it could be the overall market at macro level news, policy news, so on and so forth. Let's say over the past 2 months, we experienced the potential increase of the treasury yield, which means that, well, market can process this piece of news as the following mechanism. So the expected increase of the interest rate could lead to the future increase of the firm's borrowing cost, which can be translated to the value reduction performance of that particular company, which in turn leads to the reduction of the investor expectation for that firms. So eventually, the stock price for that firm is going to be jumped by a lot, given this mechanism. Okay, so if you look at the stock prices over the past 2 months, well, those high-tech companies actually discounted by a lot given this piece of news, because those companies are usually high growth. So the interest rate specific news matters a lot for those growth companies and high-tech companies. Okay, so news matters. Okay. So you can see this is the performance of the Nasdaq over the past year. So what I'll highlight over here was the performance soon after the news of a treasury yield increase that coming into the market. You can see the NASDAQ dropped by around 12%. If you look at those high growth stocks, some of them dropped even by around 30 or 50%. Okay, so what can we do as retail investors? During that time, I believe every one of us were kind of a panic. Okay, so it's kind of hard for us to time the market. It's extremely hard for us to locate to the bottom. Okay, so I will come to that in terms of how we cope with this kind of issue. And here you can see is the this V shape is the stock price trend during the pandemic outbreak in 2020. The overall market dropped by 30%. Okay, so I personally didn't sell my stock during that time. I think most of the stocks I still hold them, but well, still my point is it's actually a mentally suffered process for me because you can hardly imagine that 25% of your wealth were just completely evaporated, right? So as retail investors, probably the best strategy is going to be long-term holding. Okay, so we want to take the long-term horizon for us to mitigate the potential risks associated with our investments. Okay. So here I want to go through a few common types of investment instruments. First is obviously the stock or equity. So speaking to the equity, it's just a financing instrument that allows firms or corporates to finance the capital, to raise the capital. Okay, so as the investor, as investors of equity, we basically invest into the venture in the hope of future price appreciation along intermediary dividend payments. Okay, so these are two primary sources of investment outcome. So dividend and the the capital gain sourced from your price appreciation. Okay, but I want to emphasize that not all the company that really pay dividend. Okay, so for example, Microsoft, before 2000 they rarely pay dividend, but recent year they start paying dividends because it's just a signal indicating that the financial well-being of the company is very healthy. Okay, so it's a sort of a signaling effect to the outside shareholders. Okay, there are preferred stock, common stock. Usually as retail investors, we play around the secondary market. Here are a few trading platforms commonly used by retail investors. So recent years, we have the Robinhood, which is very user-friendly and very easy to implement. There are some issues coming around, and that is regarding the security. I personally use the TD Ameritrade, which is more professional. Basically, it allows you to impose some advanced trading strategies. Well, to each own. I think there are many others are also very user-friendly. For example, Fidelity, Weibo, or Futu, so on and so forth. It's just up to you. Okay, so I just want to point out there are a variety of trading platforms or brokerages. Okay. The second type of investment could be government bond or corporate bond. So different from the equity security. For bond, it's basically a fixed income security that allows you to get a pre-specified level of income within a pre-specified, predetermined investment horizon, which we call maturity. Okay. Excuse me. So, like I said, the major difference in terms of the cash flow pattern, the bond has a pre-specified level of income, which is something we call coupon payment. Also, it comes along with a predetermined maturity. So the investment horizon is pre-specified, whereas in stock, you don't have a pre-specified horizon. Okay, so that's a primary difference. So for government bond, we have short-term bond, which is Treasury bill. It could be 1 month, 3 months, whatever. And also we have the long-term Treasury bond, which is which is associated with a horizon that is beyond 1 year. Okay, so we have 30-year Treasury bond as well. Okay, obviously with longer time to maturity, your return should be higher because of the opportunity cost is higher. Okay, so speaking to the compounding frequency or the coupon payment frequency, it could be well, most likely a semi-annual basis or sometimes quarterly basis. Okay, so well, you will learn more detail in future chapters. There are also another type of investment vehicle, which is mutual fund, which is basically a pool of money of many investors. Okay, so basically it's just a pool of everything. Okay, so one primary reason that people opt to a mutual fund is the fact that the mutual fund does a pretty good job in terms of the diversification. Okay, so in finance, we actually have a theory indicating that diversification can help us to lower the risk. Okay, so basically, we don't want to put all our eggs into one basket, and mutual fund can help us to do a better job. Okay, so it's more like a sort of a sophisticated institutional investors. So basically, they have more access to more information. They are more well-trained. They have more professional background knowledge that allow them to make informed decisions where seems to be costly for us to to do. So mutual fund is another good investment vehicle. All right, so there are also something called real estate, which we covered a few weeks ago. So obviously the primary downside or the limitation is the liquidity associated with the real estate. Okay, so there's a huge liquidity discount compared to stocks. That's one downside. I really don't like the real estate investment. Okay, so I don't have too much comment on this instrument, which we covered in previous chapters. And there's other investment alternatives such as derivatives, options. So by options, it's basically an invention that allows investors, that give investors the rights, but not the obligation to buy or sell the pre-specified underlying assets with a pre-specified exercise price and the expiration date. Okay, so it's something a little bit advanced, but it's actually a very useful tool that allows us to implement effective risk management. Okay, so if you're interested in that, you can talk to me during my office hours. I'm a big fan of options. Okay, but for beginners, I don't advise you to use derivatives or invest in your money into commodities or metals or whatever other alternatives. It's kind of a high risky. Okay, so because usually well, the time horizon is pretty short, and also the volatility associated with this type of investment is pretty high. So for beginners, especially when we are unsure about our risk tolerance, it's going to be a dangerous practice. Okay. So here is kind of an interesting slide. I want to share with you guys some of my thoughts in terms of the sources of investment information. Okay, so as investors, we always want to be informed. So what are the primary sources? First thing, it could be the newspapers such as the Wall Street Journal or Barron's, Bloomberg. These are the primary, mainstream financial media, which I commonly read. Actually, this semester, many of your weekly readings are selected from those financial media. Okay, but the point is, does the news drive the financial market or the other way around? Okay, it's actually a question mark. Okay, so there are huge finance, there are opposing forces in terms of the financial theory in explaining the news return relationship. Okay, so we actually want to be careful in terms of how we interpret the news. So I think the most important thing is that we want to understand our investment by looking into the future company's prospect. Okay, so we can look into the corporate reports, financial statements, or earnings report. Basically, every quarter we have the quarterly reports. We need to learn the details of what's going on. Okay, at least you have to, at the minimum, you have to be very sure about what you are invested. Okay, so this semester, some of my students, not only in this course but in many in my other classes as well, coming to me and they ask me, how do you, what's your opinion on this stock? What is your opinion on whatever investments? Okay, I ask them, how did you know this stock? Okay, so their answer usually turn out to be, I heard from whoever bought this stock. I heard from my friend, something like that. So you know what? This kind of behavior is what we call herd mentality. Okay, so it is kind of a biased. When you get that piece of news into your pocket, it's kind of a hard for you to profit because the market is fully efficient. Okay, so when you get a news, it's already too late. Okay, well, maybe you can argue you can succeed once or twice, but I can tell you, if you seriously treat the investment, you cannot consistently profit in the long term. Okay, so we want to pay attention to the firm's fundamentals and to the firm's future prospects. There's another resource I personally like to use, which is the grid index offered by the CNN. You guys can check out the links I embedded in the slide. So basically, it's the index that captures the overall market sentiment. Usually, when the market is overly hot, people tend to be very greedy. Okay, so every one of us think ourselves to be the stock professional or investment professional, which is obviously inappropriate. Okay, so if you check the great index of over March 2020, right after the outbreak of COVID-19, it's actually around here. Okay, around your left-hand side. Every one of us were extremely fearful because of the everything was onshore. Okay, so people as human beings, we're kind of uncertainty averse. Okay, we don't like uncertainty. But right now, you can see it turns out to be very greedy. Okay, so we want to be clear what's going to be the market sentiment. And actually, here's another measure I want to look before I make the investment, and that is the VIX, which captures the volatility of the market. So it's basically the inverse of the market performance. Okay, so the higher the VIX, the more volatile of the stock market. Okay, so you can see during the pandemic outbreak in March 2020, the VIX is pretty high at the level of around 80, 85. So usually this, in a healthy environment, should be below 20. Okay, so in the correction in July, it bounced back. In the correction in August, it's pretty high. Right before the presidential election, pretty high. Right after the Treasury yield news release, it's pretty high. Okay, so it's actually a very important measure that help us to understand what's gonna be the market sentiment. Okay, so these are the important things I want to make sure, guys, before you make the investment decision. So Next, I want to mention, I want to present this graph to you. Basically, it sum up the structure in terms of the risk profile in terms of across different uh, financial classes. Okay, so down the bottom, you have the most secure investment alternatives, including the cash, large certificate of deposit, a money market fund, and government bonds. So these are usually very safe, but obviously the return on those assets turn out to be very low. So moving up, you have stocks and the corporate municipal bonds, income stocks and conservative mutual funds. Then you have growth stocks. So basically small firms, high-tech firms, growth-oriented mutual funds, and rental property. So this turned out to be a little bit more riskier. Okay, so on top of everything, you have the speculative stocks, options, and the financial derivatives, along with other high-risk investments. So like I mentioned, for beginners, I would like you to focus on level 1 and level 2. Once you establish your risk tolerance, you can moving up and form your personal portfolio that can, properly balance the risk and return. So speaking to the role of a financial market, okay, so it's kind of important to realize that financial market has multiple roles, okay? For one thing, it provides a marketplace to match the buyers and the sellers. It's basically a liquidity provider, okay? So it's just sort of a marketplace. From the corporate perspective, financial markets allow the firms or corporates to allocate, to raise the capital. Okay, so it's basically allow for capital formation. It's very important, it takes the indispensable in the financial system. Also, the other way we can interpret the financial market is that it's a place that reflect corporate internal decisions. So within a corporate, there are a variety of decisions, such as investment, such as governance, such as financing. So basically, financial market is a place to reflect those decisions, which in turn, alter the price movement. Okay, so that's my way to interpret the financial market. Oops. Over the next few slides, I want to illustrate the the price movement across different financial assets. So this graph captured the return of $1 over past 100 years across a few assets. So down the bottom, you have the inflation. Obviously, the return is nothing. Okay, then you have Treasury bill, which is the safest asset in the world, endorsed by the government, and long-term bond. So you have longer horizons, so the return is a bit higher. So you can see on top of bond, you have small stocks and large stocks. Obviously, small stocks, they have lots of, because they are small cap, they are associated with stronger growth because they have lots of ideas to plow back for future growth. Whereas large companies turn out to be more stable. So usually the return associated with large stocks turn out to be more stable. Okay, but of course it's more safer. Oops, how come? There we go. So this slide basically is the reinterpretation of the previous slides with more detail. You can see on the left-hand side, it's the return of cash, which just to mitigate the inflation, 3%. And then you moving on, you have the hedge fund, the non-yield debt, non-US bond, the long-term treasury bond. You also have the international stocks, equity, and on top of everything, you have risky private equity. Okay, so obviously this graph helps us to sort out the risk level across different asset classes. So then we have the return on different classes in the US market. And well, if you take the international perspective, it's actually the similar structure. Here is the illustration of the Australian market. It's basically the same. But what I want to show you is the fact that the news of the market, the exogenous shocks associated with news can actually navigate the stock return by a lot. Okay, so you can see the time varying price evolvement, especially during the 2009 financial crisis. You can see it dropped by a lot. And during early 2000 dot-com bust, you can see it also dropped by a significant percentage and takes a very long time to bounce back. Okay, so there is one stream of a theory arguing that it is the news that come into the market shaping the overall financial market. Okay, so we want to pay close attention to the financial market in terms of the news going out. Okay. Now, I want to talk about the impact of the COVID-19 pandemic outbreak. Okay, so on this graph, it captures 2 years trend of a stock price, S&P 500 performance over the time span of 2018-2020. You can see the general trend is upward sloping. Okay, so if you enter the stock market somewhere here, okay, you will be shocked once the stock dropped by 30%. So as retail investors, what should we do when we saw the when we experienced the coronavirus outbreak? Well, actually, the famous value investor Warren Buffett give us the answer. Okay, so do not buy or do not sell. Okay, so we want to sit over there and just hold our investment and take the long-term horizon. So we want to buy and forget. So basically, that's probably the only way for us to mitigate the volatility, because for the reason I mentioned, we have behavioral biases, especially during the market downturn. It's very likely for us to make uninformed, impulsive, irrational decisions during the bottom of that V shape. Okay, so don't ask me why. It's just a human bias. Okay, so I will illustrate this idea in the behavioral finance video, which I'll post later. Okay. Well, given that V shape, the surprising reality is the stock price bounced back soon after the virus outbreak during late March. You can see, well, if you hold the stock over the past year, your stock return is supposed to be at least 30%. Okay, so if you wrap your gain, if you liquidate your position during a panic, well, probably that's a huge loss. Okay, so in the next slide, I want to show you the comparison of a stock return all across 3 primary financial crises in terms of the dot-com crisis, subprime mortgage crisis, and the COVID-19 crisis. So you can see every one of them are kind of different in terms of the recovery time span and the nature. Okay, so you can see COVID-19 is extremely unique. The V shape is, it's pretty sharp decline and increase. Okay, so likewise, like I said, it's very easy for us to mistakenly make the decision. I personally hold almost everything, so I was actually fine last year. So there is another important graph I grabbed from your textbook, which I thought would be an important thing, and that is the diversifiable risk and the market risk. So basically, on this graph, on the vertical axis, it's the portfolio risk. On the horizontal axis, it captures the number of stocks in your portfolio. Okay, so in finance, we talk about the diversification. Okay, so basically, the firm-specific risk or individual risk should be diversified through your portfolio formation. Okay, so by diversifiable risk, I mean that's something specific to the individual firms. For example, if the CEO of that company engaged in or trapped into some scandal, that's something, you know, firm specific. Okay, for market risk, we are talking about the policy news or you know, the macroeconomic trend or whatever, something systematic. Okay, so in finance, we talk about the diversification. So, well, basically, your firm-specific risk can be fully diversified through portfolio formation, where you will be only compensated by the systematic risk associated with, well, which is captured by this component. Okay, so only systematic risk or market risk will be compensated, and the firm-specific risk can be fully diversified through the portfolio formation. Okay, so here are a few graphs that captures the profile of returns across different asset classes. Here, this one is the large company stocks, and this one is the long-term government bonds. You can see, because of the given nature of a bond, for most of the time, except a few special periods, most of the time, this instrument are pretty positive. But right now, we are in an exceptionally low interest environment. So probably that's not a very return-driven instrument, but it's pretty safe. Okay. We have short-term treasury bill. Yeah. Oh, by the way, this is another important concept I want to mention, which is the risk premium. So basically, it's a measure that captures the return in addition to the risk-free rate captured by the U.S. Treasury bill, which is, you know, usually endorsed by the U.S. government, and in the short term. So basically, if you want to look at the return of long-term government bonds, suppose it's 85%, the risk premium associated with this bond is going to be 5.8% minus 3.8%, which is 2%. Likewise, you have small stocks. Suppose the average return is going to be 17%. Well, the risk premium, in other words, the return you can get in excess of the risk-free rate is going to be 17.1 minus 3.8. That's going to be 13.30%. Okay, that's it. Simple enough. It's basically a measure that captures how much degree you will be compensated in excess of the risk-free rate for that particular investment. Okay. So to sum up this chapter, I want to share with you guys my personal philosophy developed, throughout my past, over 10 years investment experience, okay? So investment is about self-control, okay? So we are human beings. We are subject to a variety of biases, okay? So we want to understand ourselves. We want to control ourselves, okay? And investment never equals to speculation. Don't confuse the two, okay? So as retails, we want to take the long-term horizon to mitigate the risk, okay? Some of the risk is just out of control. Well, you can argue that in the short term, you can, well, make the money once or twice, but if you seriously treat the investment over the entire lifespan, you cannot escape from the financial crisis. I guarantee you, you cannot, okay? And you cannot escape from the whatever corrections, seasonal corrections, you know. As long as you experience one financial crisis or one whatever corrections, 30% of your gain will be completely evaporated. So whatever, you know, how much you made in the past, you will be, you know, you will given giving them back to the market. Okay, so the only solution for us to do is to implement is the long-term horizon. Also, we want to diversify our investment portfolio. The focused portfolio is sometimes too risky. Okay. Also, we want to, establish our risk tolerance, and we want to control our sentiment or emotions. Okay. So to sum up, I want to give you guys this sentence. Try to be friend with time. Okay, so we want to invite time to be our friend. Ask time to solve everything. Okay, that's extremely important, and I hope my lecture is gonna be helpful for your future investment decision process. Okay, I will see you guys in the next video.